Hello everyone, I'm Sahil and welcome back to the channel. It's been a while and I'm quite a bit late for my monthly update. Don't worry, I didn't go missing. I just had some exams at the end of the month, and after that I took a little break of like 2-3 days just to get all the shit out of my head. And the exams really didn't go well, and I guess I have to put in more efforts in making these videos because becoming an engineer is apparently not happening. Just kidding. Anyways, let's get it rolling. Alright, so let's start by taking a look at S&P 500 today. This is an index that is like the biggest 500 companies of US, and it is used by people worldwide as the benchmark for market performance. And if we see in the past 1 month, actually little over past month, from April 1st to 6th of May, when I'm filming this video, it has gone up by 4.5%, which is a amazing performance like for a month. And then we look at HSI, which is the Hang Seng Index from Hong Kong, which consists of mostly Hong Kong and Chinese companies. It is down about 1.13% in the same period. And if you look at the STI, which is the Singapore Index, Straits Times Index of like the top 30 companies in Singapore, as in the biggest 30 companies in Singapore, and it's a tad bit up about 0.5%. And now let's go and take a look at my portfolio. I'm down about 1.57% during the same period, and this is by no means good performance. Like, we all pick individual stocks in order to beat the overall market returns, right? And if we can't even do that, what's the point of putting in so many hours doing all the research and keeping up with the individual companies? If I would have invested into S&P 500, I would have been better off by 6% as compared to my portfolio over here. But that's not everything, right? Beating the market is not everything. But I mean, it is over the long term, but for me right now, it's also about to learn how to do that. It's also to get the knowledge and understanding of how to pick the individual stocks, the winners of the market, so that I am able to beat the market over the long run. Also, like in 10 years time, I would have way more money to invest than I have right now. So it's better if I make the mistakes and learn right now than maybe 10 years down the road. I don't want to be the person who's investing into S&P 500, right? On top of that, when I have done my research, my due diligence into the individual companies, I have conviction into them. I know what is the fair value. We have already done the valuation. I know if let's say Ping An Insurance is worth $100, it's worth the $100. But in the short term, if the price is dropping down, it's just a buying opportunity for me, right? For example, if you go to Starbucks today and you buy a cup of coffee for $5, and tomorrow you go there, if the same cup of coffee is selling on a discount of 10%, would you be more willing to buy the cup of coffee, or would you be less? Would you say that, oh shit, this company's this cup of coffee should be trash? No, right? If you like the cup of coffee, you would be more willing to buy the cup of coffee after the discount. Same way, if you like the company and your investment thesis have not changed, then you should be more willing to buy the company when it's selling on a discount, right? So that's it for me as well. Like, if I have done my due diligence, I know Ping An is worth $100. If it's selling at 80, I'm buying more. Provided things have not changed, provided my investment thesis is still intact, provided the cup of coffee, they're not like reducing the amount of milk in it or something. So also I want to mention that obviously like my returns are trash as compared to the 2x or 4x other YouTubers would be making around. But the thing is, you should know that they only show the good performers, and not much of the people are willing to show the entire portfolio publicly. But I've made my promise, and I would be showing you every month my portfolio without frills, up or down. I will still be here, and you can actually go and check it out anytime you want from the link in the description below. That being covered, let's look at the individual companies in my holdings and see what is moving the price and what happened in the past 1 month. So firstly, we have ST Engineering. It is down about 2% from the last update. And nothing really happened much in the company. They had ex-dividend date last month. So there was a slight run-up coming to the ex-dividend date, and then there was a bit of sell-off. And actually, the company is buying the shares right now. They bought back about 1 million shares. That's worth about $4 million. So yeah, this is, on average, they are just like when they buy back, they're buying back about 500k shares at a time. So this is like, it's been a long time since they bought over 1 million shares in one go. So yeah, and then we have KPA-BM Holdings. Nothing changed about them. It's still the same price. It was fluctuating a little, but always been up over 30 cents. And then we have the three Singaporean banks, DBS, OCBC, and UOB. They all posted their quarter one results at the end of last month or early this month. So let's go take a look at that. But before we do, one thing to take note is that I've seen a lot of headlines saying that DBS had a growth of 72% or OCBC doubled their revenue and those sort of things. But that is not the complete story. And I hope that you are not misled by them. So let me show you, like, this is the DBS's quarter one results. And if you see, DBS's business actually wasn't affected much last year, the Q1 of 2020. Their business wasn't affected yet because of COVID, because until March, coronavirus was still confined in China, and the effects were not seen in other parts of the world until I think April or so. So the revenue for DBS in quarter one 2020 actually shouldn't have been affected, but we can see a dip over here. Why was there a dip? Well, it was because of these provision of losses that we see over here. This is not actually a loss, but they just set aside some money in case there were losses going ahead in the year. And this obviously artificially decreases the revenue, right? But if we adjust for that, Q1 2020 DBS revenue actually increased by 13.3% from the year before. And if we use that number, right, the revenue this year actually decreased by 4.5%. And now this is the reason we should learn how to read financial reports instead of relying on headlines or the sugar-coated stuff on the earnings report or so. So now if we look at the earnings also, they actually decreased by 10.3%. So in reality, DBS didn't perform that well, but looking at the circumstances, it's still great, and I think investors still rewarded DBS for that. At first, a bit too much. It went over $30, and now it's slightly corrected back. And same goes for UOB as well. So UOB actually had no changes in their revenue if we take the adjusted revenue. And the earnings actually decreased by 0.26%, which is not a big one. Like if you read the headlines, right, UOB, they said it grew by, the revenue grew by 18%, whereas DBS actually grew by 72%. But in reality, you see UOB is doing better than DBS over here. I won't cover OCBC because I've actually sold off my holdings and the 5 shares doesn't make a difference. So I'm not going to cover OCBC anymore. Also, I was expecting DBS and UOB to increase their dividends since last year, Monetary Authority of Singapore actually asked them to cut their dividends in order to preserve cash for in case COVID gets worse. But most of the countries that they have businesses in, especially in Singapore, coronavirus is contained, and I guess they should have relaxed the cut and maybe increase the dividend, but that didn't happen. So we are waiting for another quarter or two. Let's see how the situation develops. Next up, we have Ping An Insurance Group, and they had a massive drop actually of about 13%. This was due to a write-down that they had last month in their earnings, the recent earnings, and also they announced that they will be taking over a bankrupt company with 51 to 70% stake in it at a cost of up to $8 billion. So this wasn't taken very well by the investors, and there was a sharp decline when the news came out. And someone was also asking me if the drop in Ping An was due to Lufax going down in value. I don't think that the effect of Lufax is that significant in Ping An, because if you see Lufax, right, from start of March until now, Lufax dropped about $12 billion in market cap, and Ping An owns 29% of Lufax, so their share was $4 billion, right? And now $4 billion compared to Ping An's market cap of $200 billion is about 2%, right? So the effect of Lufax would only be 2%, if any, from the start of March until now. If the market is punishing Ping An more due to Lufax, then I would actually be very happy about it, because Lufax actually beat their earnings, the recent earnings, right? And after that, the price started dropping. So I think it's just some other things into play. It's not about the company. So for that reason, I think the price will recover, and that would be good for Ping An as well, in case the market is punishing Ping An because of Lufax. So yeah, actually I have already made a video of Ping An, so I would be making a follow-up video covering all the things that I've mentioned earlier and how that affected Ping An, and also cover their earnings together with it. So if you're interested, just wait up for that video. Next we have DBS, not DBS, VNS International Holdings. This has actually just doing its regular fluctuations. There's no news, nothing happened really, and just investors coming in and going out. It went up to 0.9 cents, like that is what, double, and then it dropped back again to 0.68. So it's fluctuating. So I think the significant move will happen when the earnings are released, which is in June. So yeah, let's wait for that. Moving on to AEM, they saw a huge drop of about 15% just after their earnings release, which was horrible, needless to say. Actually, going back to last year, right, they had a record earnings, and their earnings grew by 85% year over year. It was largely driven by Intel purchasing from them. I mean, Intel was investing heavily into their manufacturing, and they were buying a lot of equipment from AEM. So they saw a lot of growth, and investors were actually expecting the momentum to continue, since Intel is really committed into investing a lot more into their manufacturing. But that didn't happen, and in Q1 this year, the revenue actually decreased by 45%, which is a large drop. Also last year, AEM did about $520 million in revenue, but their guidance for this year is about $420 million to $500 million. So in the best case scenario, they would still only match last year's revenue. Yeah, so we should be actually expecting negative growth in their revenue this year. But I'm actually very happy to see what has happened. I mean, even their guidance being same as last year is pretty impressive, because that means that they have managed to find more customers. That was actually the biggest risk AEM had, that they only had one single biggest customer driving their revenue. But them projecting good numbers for the following year as well is actually it actually shows that they have managed to get more customers. And the chairman himself mentioned in his statement that if Intel is willing to buy from them, that means their equipment is credible, and obviously this makes it very easy for them to expand their customer base, and we should be seeing that effect, the snowball effect, going down year over year from now. So I am still glad to be invested into them. Next we have Ping An Healthcare. Now this one, I would have to admit that this is something that I made a mistake on buying at the peak. So this got hyped up by ARK, and I was expecting that. I was actually tracking Ping An way before than that, before ARK got in. But when ARK got in, I got really scared that the price will keep on spiking up. So I went in and purchased. It was a bit of a FOMO effect. So yeah, nevertheless, now the price is going down with ARK's ETF going down as well. And yeah, I didn't do my valuation on them. That was my mistake. So if I did my valuation, I would have known the price to get in at. But honestly, I don't know how to value a company that is not profitable yet. So I will be making a video on it. I will be like sharing my thoughts on Ping An, a company analysis video, and try to do a valuation on them, find out a way to do that. If you're interested, just wait for a video. I guess I have to make a lot of videos this month. So yeah, next up we have JD. Now JD has been down as well. According to me, the recent drop is due to the far-fetched deal with Alibaba. Now this is something that I have been tracking, but I didn't mention during my previous video on them, on JD. JD itself has not announced anything about the deal yet. I mean, how they are reacting or what changes they are making. So I don't want to talk much about it as well. I will be waiting for their earnings this month, right? JD's earnings are, yeah, May. So JD will be releasing their first quarter earnings this month, and probably they will talk about it. So I would wait for that and cover that out at the same time. If you're interested to know what is the deal, actually just Google and you would know. Farfetch was actually involved with JD at first, and they merged their Top Life, the premium white glove service kind of products are with Farfetch. Now Farfetch has a exclusive deal with Alibaba, so I'm not sure, does JD get back the Top Life, or what happens, and how JD would be going forward into the ultra luxury segment. So yeah, that's something that is not so clear yet, and actually means a lot to me, and I will be keeping my eye on that thing. Next we have AAG Energy Holdings. They also released their earnings last month, and that was a pretty great earnings. Like, they decreased by a little, but that was more than expected out of them, because you know what happened last year, right? The energy prices dropped so sharp. At that point of time, AEG lost a lot of market cap, a lot of value, and that was the price I bought in as well. They were trading at $1.40 prior to all the COVID thing happening, and then after that it dropped to $1, which is more than 40% decrease. And I knew like AEG their business won't be affected, because the demand for natural gas in China is way beyond what the domestic supply is. So China actually imports a lot of natural gas, and even if due to COVID there was a drop in the demand from the industrial sector due to lockdown and something, I knew that China would actually stop importing before they actually cut down the domestic supply, and then again AAG won't be affected by that. But at the end, in the winters, China released a new regulation for off-peak pricing of natural gas for like retail use, for the homes, for heating of the homes and stuff. So that had a negative effect on the average sale price for natural gas for AEG, and that was why there was a negative number. If you just see the volume of gas they sold, it actually increased, and this prompted a slight decrease in their dividend as well, of about 3%, which is not very much, and it still is about 11.5% yield on cost for me, so which is great. Lastly, we have China Water Affairs, and yeah, this is something my favorite stock, as you would already know. It has not moved pretty much. It's pretty steady at what it was. I mean, last month it was higher, but if you see the long-term trend, is just very stable, and I would say it's highly likely that CWA will explode in price in the next 1 or 2 months, or at least during their earnings this year. So yeah, I think they will cross $7 by the next 2 months. Highly likely, you know. All right, so that's all for my portfolio. And at the end of April, my net worth stood at $126,211, which is a slight drop of about 0.8% from the month prior to that. Now it's time to move on to the interesting news for the past month. So first we have US is asking the major economies to have a global minimum tax of 21% to, quote, level the playing field. I say it again, level the playing field by increasing the tax of everybody around them. Now this is an absolute joke. And who the heck, which smart fella came up with this thing, and they put it as playing the level field. I mean, everybody knows that US is increasing their corporate tax rate from I think 28% to something, 21% to 28% or so. So yeah, I forgot about it. But whatever the thing is, they want the entire freaking globe to increase their taxes so that US doesn't become anti-competitive. Like, what the fuck? It's just it's just so stupid. I can't even take it. Cancerous. But whatever. I mean, and of course, Miss Yellen is also backing that up, and she's also suggesting an unrealized capital gain tax, which is so dumb. They seem to be high on something. I think they're also smoking some weed or whatever. Let's move on to the second one. Let's let this go by, the stupidity. So China is putting a limit on foreign financial institutes. A couple of years back, they actually started in, like, opening up to the foreign financial institutes and the financial system to them. But recently, in December, they implemented a rule which limited how much money foreign banks can bring in or move out of the country. And also recently, I mean this month, they have put a limit on how much loans the banks can make. This, I believe, is to like ward off the effect of cheap money and not letting foreign banks have debt on local companies. So CCP cannot manage the foreign banks so effectively, right? They cannot control them. For the local firms, they can control them. So even if something goes bad, there's some defaults and something, local, CCP can step in and do something about it. With foreign banks, they can't, and foreign banks will just start owning all the assets if something like that happens. So I think that's what CCP doesn't want. So they are warding that off. And at the same time, due to this, the local financial institutes are becoming more competitive in a way that all the foreign companies that are now moving into China, they would have to they would have to get the capital. If they're raising debt, they would have to raise it from the local financial institutes instead of foreign banks. The third news is about MorningStar, which gave a trashy review to ARK. Oh, it was horrible. Yeah, I guess you should go and read it out yourself. If you're not willing to spend the time to read, then I would suggest that you watch Joseph Carlson's episode on that. I will link it down in the description below. He's another YouTuber which I personally watch and admire. So I think he puts it up pretty well and explains very well what the review is about. And I suggest that you go and watch that video. And the reviews. Okay, now the fourth news is the regulators are making Jack Ma to completely divest out of Ant Group. He's facing some music. Like, it's amazing his one statement can bring him so far. So yeah, he currently controls about 40% of Ant Group in the way the company is structured. So indirectly, he controls the two companies that has about 50% ownership in Ant Group. So so now he can't even sell his stake to other entities or individuals that are remotely close to him, and he has to completely divest out of it. This is very, very serious, and this information is actually not something that was made public by the company itself. It is something that was leaked out to routers from 3 individual sources, and they say that the sources were, even though individual, their stories mashed up. So this is something I will leave down in the description below as well. You can go there and read it out by yourself, and it's up to you to believe it or not. But this is very, very serious. Like, they literally just kicked out Jack Ma out of Ant Financial just because he made some bullshit remarks about CCP. So, okay, that's it for this episode. I'll see you in the next one. Ciao.